In this chapter, we'll do an introduction to financial management. And what we really want to look at is just some basic concepts into how companies make decisions. So, the first several chapters that we'll talk about throughout these slides really talk about the decision making process. What is it about the business that provides the background, if you will, of how managers actually make decisions? So, in the videos that will follow, we will talk about companies, how they're constructed, talk about some basic constructs of financial thought. We'll then develop some tools to use in our analysis. And then finally, we will apply the tools, the techniques, the concepts of finance to some actual decision-making problems that a corporation might find. So today we'll just talk briefly here about introductions, right? What does a business look like? What should the objectives of the company be? How do we find values? And then we'll talk a little bit about securities themselves. So corporate finance provides the skills managers need to identify and select strategies that are going to add value to the firm. That is a key construct, right? The decisions we make should be geared to adding value to the company. We want to figure out where we're going to get the money to do those projects. So we need to forecast funding requirements. So those are two basic tasks that we have to do. Saying that slightly different, there are basically three things we need to do. We need to figure out investment management, find those things we want to buy. 2, cash management, manage the cash flows of the company, both inflows and outflows. And then finally, we need to manage the finances of the company. Figure out where the money's going to come from to do the things we want to do. So how do we start up a company? Well, there are 3 basic types of corporations: sole proprietorships, partnerships, and corporations. And there are a variety of hybrids: subchapter S, LLCs, LLPs, and there is a boatload of other alphabet soup types of acronyms to discuss different types of organizations. They are all, in general, combinations of these 3 things. Whatever those factors are, whatever the underlying foundation of those 3 forms, they are combined in different ways to get these hybrids. A sole proprietorship, it's owned by one person. Typically, if they have any employees, they're not going to have many. They're very easy to create, to challenge. So there's no separation between the firm and the owner. If something happens to the owner, the company is essentially dissolved. They have a very limited life because they are limited by the life of the owner. On the other hand, the other thing that is very important is the concept of unlimited personal liability. We'll talk about this maybe in some later slides, but essentially, a sole proprietor is responsible for everything that happens. So what that means is that if something bad were to happen to the company, the sole proprietor is responsible to pay for all of those things. Where do they get the money? It's not just the business assets, plant and equipment, etc., but it also boils down to their own personal assets. Could also be at risk. A partnership is very similar. We just have more than one owners. Again, all the partners are personally liable for everything that happens to the company's debts, but they're also responsible for any alternative liabilities of the company. Should it be sued, each partner is liable for their share of any of those losses. And of course, a partnership ends with the death or the withdrawal of a single partner. So even though the business will continue, technically, if a partner passes away, the business continues, but technically that partnership ends. A limited partnership is a variation of this where they actually have two types of owners. We have a general partner, liable for everything that happens inside the company. They typically run the company. Limited partners have limited liability. They can't lose more than what they've invested in the business, but they also have no management authority and cannot be legally involved in any of the decision making for the business. So there are actually timeline limits for how much time a limited partner can be present in the business and still maintain their limited liability. Now, there are limited liability companies where these basically look like limited partnerships, but these owners can also run the business. So again, it is a variation of a limited partnership. Corporations are legal separate entities from its owners. They have the legal powers that an individual has. About the only thing they really can't do is vote. Corporation is solely responsible for its own obligations. So this creates what we refer to as limited liability. The owners have no liability for the actions of the corporation itself. Of course, there are more details here, right? There's more legal requirements to create a corporation because of these benefits. So they have to be legally formed within a state. They form what's called a charter, right? Because of the legal environment, turns out that Delaware is a popular choice for corporations. The reason for this is that Delaware has a part of its judicial system is a judicial branch, if you will, that is entirely devoted to business. For a corporation, ownership is represented by a share. Of course, we know what the stock is called, right? Shareholders, stockholders. The sum of all of that value is called equity. There's no limit to how many shareholders we can have. So there's actually no limit, technically, to how much funds a company can raise. If you review Disney, Walt Disney Company has in the ballpark 1.82 billion with a B shares of stock. So it's a very wide distribution of shares. Of course, what are the owners entitled to? They're entitled to dividends. They're entitled to the profits of the company. They are entitled to vote for major changes that happen within the corporation. So let's take a moment and discuss a little bit this idea of liability. How do you define business assets? Well, the simplest definition is it's the assets the business uses to produce revenue and provide services. However, that's not the entire answer. A better definition refers to the assets of the owners that are at risk should the company encounter challenges like bankruptcies and lawsuits. So what are the business assets of a corporation? The common stock. What are the business assets for a sole proprietorship or partnerships? All the assets of the business, including the personal assets. So limited liability or liability refers to the responsibilities should one get sued. Unlimited means that all business assets are at risk. Limited means only invested capital is at risk. So how do we choose what type of business form we want? In practice, we don't really have a choice all the time. So there are some factors that are important to us. Number one, primarily, I believe, is risk. The riskier the business, the more you're concerned about your liability. The more risk there is, the more likely you want to have limited liability. So you want to be either a limited partner or you want to be a corporation. What about funds? If you need a lot of money to keep your money up and keep your money growing, you need to have access to financial markets. That typically leans itself more towards corporations. What about taxation, right? How much of the profits of the firm do we get to keep as owners? Turns out that the tax rates on owners of a corporation are lower than the tax rates for individuals. However, we'll talk about this later, taxation is double taxation for the corporations. If you own a corporation, own its stock, the corporation pays taxes on your profits. They pay taxes. When the company then pays you dividends, you have to pay taxes again. So that even though the tax rate is less for corporations, all of the funds are essentially taxed twice. And finally, the last thing we might be concerned about is control. Who controls the companies? We want to make sure that the owners, we need to understand what level of control they want. If they want lots of control, they need to stay very small. As they grow, as the company grows, owners lose control of the company. I mentioned briefly the idea of tax implications and double taxation. S corporations are a form of a corporation where the profits are not subject to corporate income tax, but instead they're allocated directly to shareholders, much as they are with partnerships. So the taxation of an S corporation is more closely related to a partnership than it is to a corporation. So how do you become a corporation? Without getting into a lot of detail, the incorporation process requires us to file a charter with a state. Once we do that, once we want to incorporate, we can decide to issue stock. So we want to go public. This initial public offering is to raise cash. I think that's pretty obvious. But one of the things it does is it allows founders, right, the beginning owners of the corporation and pre-IPO investors to harvest some of their wealth. I mean, they're taking all the risks in the beginning. This could be part of their payoff. And of course, now there are also other subsequent issues of debt and equity as the company continues to exist and continues to expand. I look forward to seeing you in the next video.